Hi guys, my name is Alexander Dimension. Welcome to the new video. Today I'm going to show you some secret information that you won't see anywhere else. It proves that the US Federal Reserve has actually already begun to reverse its policy from quantitative tightening to quantitative easing. I would love your support and likes. This video should definitely be circulated, because I noticed that no one is talking about it. So the more likes there are, the more chances that YouTube algorithms will pick up this video and distribute it. So secret information shows that the US Fed has already started turning their policy around. They just got the green light at the traffic light to turn the money printer back on. And you'll be surprised at what they come up with. Watch this video to the end. It's happening right now, so you better be ready for it. So, let's break down the actions of the US Fed, Jerome Powell, and the US Bureau of Labor Statistics, oddly enough. So we'll understand what might happen next with the purchasing power of the dollar, pension funds, house prices, assets, and, of course, with Bitcoin. Just recently, there was some government change that gave the US Federal Reserve political cover to stop the quantitative easing policy and move to quantitative easing. I want to remind you what quantitative easing is. It is when the US Fed reduces its balance sheet, raises rates, and siphons liquidity from the markets. Quantitative easing, on the other hand, is the reverse process, where, in short, markets are flooded with cheap money. This usually leads to explosive growth of assets. The transition from one type of policy to the other is what the US Federal Reserve calls a policy reversal, and it looks like the green light for such a reversal is finally on for the US Federal Reserve. Let's break it down. What has changed? Why the Fed started the reversal and why no one noticed it, and what consequences it will have for the market and investors. Don't forget that this is not financial advice, just educational content filled with my thoughts. Let's start with the first slide. US Fed obligations. By this I mean actions that the US Fed is obligated to do, but if something changes, they are not obligated to do. Let me give you an example. I think Jerome Powell, when he speaks and says something on behalf of the Fed, he really believes what he says, but then something changes. The economic environment, for example, and so he says different things. So, for example, in 2020, he said they weren't thinking about raising the rate. Then he said they weren't going to raise the rate for the next 4 years, but then 2 years later they started raising the rate, as you remember. Now they're saying they're not going to lower rates in 2023, but will keep them high for a long time. I'm sure he really believes that. He believes that the US Fed is going to keep the rate high and not cut it this year, but that's if nothing changes. Jerome Powell said the US Fed should continue to do that. What's that? Lowering the consumer price index, of course. Jerome said that the FDC should cave in demand, and do so as hard and unpleasantly as possible. In other words, the FSR should make everyone poor. Unemployment should go up, wages should go down. All of this, of course, is unpleasant and harsh. But it will destroy demand and bring inflation to the rate of 2-3%, which is what the US Fed is aiming for. Now the question is, now, in 2023, does the US Fed need to do all this? Powell says the US Fed should do it, but it doesn't have to if it's unnecessary. What if they don't need it anymore? What if I tell you they're almost there? We remember the extreme CPI report. Inflation collapsed from 9.1% to 6.5%. So the US Fed is already getting that inflation decline they've been aiming for. Perhaps that's enough already? Now you're going to see what they've done. Now you're going to see how they changed the rules. One of those economists and analysts worth paying attention to is Harry Dent. In his forecast for the stock market and Bitcoin in 2022, he said the markets would collapse 70 to 90%. Well, Bitcoin is down 78% in 2022. So Harry Dent's prediction came true. You know what this man is now predicting? The collapse of all life is coming. A stock market crash of 50 to 60%. We won't get out of this until 2025. This is his latest prediction. It sounds serious, and maybe it will be. Nobody knows the future. But all I can say is that Harry Dent, as well as Peter Schiff, who is also predicting some terrible crashes, especially for Bitcoin, are missing one interesting thing. They were right, I agree. But what they don't take into account is that the US Federal Reserve has changed the rules of the game and is manipulating the markets completely. And they changed the rules in a way that no one noticed. But hopefully, after my video, we will correct this mistake. Let's go over it point by point. First, manipulation of information. Lie to them. If you can't change reality, lie to them. That's what the US Fed does. We have to understand that the consumer price index is a manipulation of the US Fed. Depending on how they measure it, its value will change. In fact, the way they measured this index last year is very different from the way they measured it in 1980, and even more so from the way they measure it now, because today they have added some other very important changes. Let's start with the first change. The Consumer Price Index, in other words, inflation no longer takes into account changes in house prices. Then they decided to include the cost of rents in inflation. They kept changing the way they calculated inflation to get not the true inflation figure, but the figure they themselves wanted to see. The second change. To calculate inflation, they replaced expensive products with their cheaper counterparts. Inflation took into account a whole basket of products. For example, steaks, milk and cheese. Inflation accounted for the price of that basket. They then twisted the way inflation was calculated. Instead of steak, they took the price of cheap burger patties. Instead of quality milk, their inflation figures began to take into account the cheapest of diluted powder. These are just two of the ways they began to manipulate inflation figures, facts and statistics. But the latest change, which occurred in January 2023, is the most significant. It's hard to even estimate how significant. I would call this latest change nothing less than a green light at a traffic light. A green light for the Fed to turn its policy around. This is the U-turn everyone has been waiting for over a year. And in fact, if we look at risky assets like cryptocurrencies, we can already see that they show us that the turnaround of the Fed could take place without most people noticing. What does all this mean? So, the government in 2023 decided to change the rules of how they count the Consumer Price Index, which is inflation. Let's be clear, this wasn't done by the Fed. No. It was the U.S. Bureau of Labor Statistics that brought the change. So, in January 2023, the Bureau announced that the methodology for calculating the Consumer Price Index in 2023 would change completely. This is very big news. You need to know that there is a system of weights to calculate the Consumer Price Index. For example, the weights for the fourth quarter of 2015 are used to calculate this index in 2018. This is quite a tricky topic, so I'll leave out the details. Let's get straight to the changes. The system for calculating the Consumer Price Index in 2023 has changed. The U.S. Bureau of Labor Statistics will now revise the weights of the Consumer Price Index each year based on only one calendar year of data. This is different from the previous method in 2022, which updated the weights for the Consumer Price Index using 2 years of data rather than one. It sounds completely dry and incomprehensible. How does this even affect the U.S. Fed's reversal? Let me explain in simple terms. So, they used to use 2 years for comparison, but now they only use 1 year. Look at this graph. This is the Consumer Price Index from January 2019 to January 2023. In the beginning, it was pretty much flat, as you can see right here. But then this explosion happened, up to 9.1%. Then inflation started falling again to 6.5% now. If we calculate this index based on a comparison with the information right here, or for example, right here, agree, the bottom line is going to be completely different. Last year they were measuring inflation compared to 2 years of data. Now it's only for 1 year. That's a big difference that you can see in a direct comparison of the two methodologies for measuring inflation. In this chart right here. Here you see the old method of calculating inflation. That's the dark blue line right there. And the new methodology for measuring inflation. This is the dark red line. As you can see, they move pretty much the same at first. Except for the last episode. This takeoff right here, for the old methodology turns out to be softer. The red line, on the other hand, as you can see, takes off much sharper and higher. And now it very much depends on where exactly the US Fed is taking its starting point. Right there. Or right there. After all, if prices are somewhere around here, for example, which gap is bigger, this one, or that one? That's the kind of trick, the kind of manipulation from the US Federal Reserve that not everyone saw. But what does this mean in simple terms? And that if nothing changes, say, prices stay exactly the same, and the US Fed does nothing at all, doesn't even raise rates, the Consumer Price Index will plummet. Now remember the commitment of the Fed. Jerome said they should collapse the Consumer Price Index. And now we're at the point where they don't even have to do anything to do that, nothing else. What does that mean? And that the US Federal Reserve has the green light to stop rate hikes and then lower them and start the whole cycle all over again. Quantitative tightening, reversal, quantitative easing, reversal, and so on and so on and so on. It is this new methodology for measuring inflation that gives the US Fed room to pause rates and even reverse. All they had to do was change the way they calculate the Consumer Price Index. And they did that this year. Now that's news, they did it. Before we move on, I hope you understand at all how important this change is. And it's important, both to the US Fed and to us. What should happen? If nothing changes, I emphasize, if nothing changes, then the March Consumer Price Index should fall very sharply. As I said, it's already started, but it should fall 2 or 3% in May and another 3% by December. The Fed is using a new methodology to calculate inflation in 2023. We've already figured out what that methodology is, and we can already use it to predict the movement of the consumer price index in the future. This is what that movement looks like if nothing changes. We can see that from January 2023 to December 2024. Right there at the bottom, there is a big drop in inflation. In December 2024, it will be minus 3%, so it's actually deflation. Until March 2023, there's a drop to 3%, and you don't even have to do anything for that. Is the trajectory clear? 9.1% last June, 6.5% now, and about 3 to 4.5% in March 2023. If you consider the new way of calculating inflation, it could even be 1.5%. The US Federal Reserve has already said it wants inflation at 2%. If inflation falls to 1.5%, that is deflation. And that means that the US Fed no longer has to, but must start printing money and pump it markets. That's what it means. Otherwise, it's going to have huge problems in the economy. Yes, we have broken down the great manipulation of the US Fed, but it is also a big lie to people. Why? Because changing the way the consumer price index is calculated won't change real inflation in any way. It won't change the price of food or gasoline. So real inflation in the US today may be the same 6.5%, but with the new way of calculating, they will draw the inflation they need. For example, 3%. It won't affect the cost of living, but it will give them the green light to reverse their policies. Interestingly, after the U-turn, real inflation could rise to 10%. Apparently, that's the way out of this situation they've found. As we saw in one of the slides, they have to manipulate information, they have to lie, to create their own illusion of reality. There's a site like ShadowStats, and it displays inflation, which was calculated according to methodology back in 1980. If you take that methodology into account, inflation is now 15.6%, not 6.5%, as the US Federal Reserve says, but they will always underreport it. Always. And this year they've figured out a way to understate it even more. Either way, manipulation, not manipulation, bullshit or truth. The US Fed's U-turn is quantitative easing, and quantitative easing is pumping the markets. What is soft landing? It is a term describing a series of actions taken by the US Fed to prevent high inflation, rising interest rates, and a significant crisis in the US economy. This is what the US Fed wants to do at the end. We are already seeing hints from the US Fed of a soft landing. Rates will not rise as aggressively. There will be a rise of 25 basis points, not 75 basis points. Inflation will be lowered to 2 to 3%. We've already talked about when that might happen. And that would allow the FX to change the rules and start pumping at markets again. We're already seeing those rules change in January 2023. If this is all true, all the things we've been talking about, the US Fed already has the green light to roll out its policies in markets as early as after Q1 2023. And risky assets are already feeling it. Bitcoin and altcoins are rising for a reason. But don't forget, this isn't financial advice. That's all for now. My name is Alexander Dimension. And you should know how this video made me exhausted, so I hope for your support by subscribing, as usual, and write a comment. See you in new videos. See you soon.